To hold rates steady and the future path for rate cuts, we have Ann Berry, Threadneedle Strategist founder, alongside Jeff Klingelhofer, Thornburg Investment Management Head of Investments, joining us now to discuss. Welcome to you both. Jeff, maybe I'll start with you. Just give me your first reaction, Jeff, to what you've heard so far.
Yeah, I think we saw the pivot to the pivot. And, I've said for quite some time, I think it was a policy mistake that the Fed pivoted to rate cuts late last year. I think when they talk about the balance of risks, they really weren't apparent when the Fed pivoted. Inflation was coming down, but unemployment was running very low. The consumer was strong. Today, they're in a different spot where we are seeing signs of weakness really feed through to the real economy. And inflation is picking up. I think the Fed has a much tougher job today.
And to Jeff's point, Ann, you were saying that there's going to be questions here potentially raised in that press conference about whether, in fact, the Fed missed this and why they missed it.
Yeah, and to come back to the Fed has consistently said they're going to be data-driven. So if we're looking for consistency, that's where it's been. What there hasn't been yet, I think, is either introspection or external assessment of how effective the Fed has been in really finding good data with really good lead indicators. The ECB's been trying to figure that out. I'm not sure the Fed has been doing it quite so aggressively.
And Jeff, so turn back to you. So for the press conference, just interested, what do you want to hear from Jay Powell?
I think it'll be interesting to see just the language, how hard they lean into the idea of their concern around inflation. But I think one thing we also should be talking about is part of this announcement has been a tapering of QT. And I think that's also a potential policy mistake, right? The Fed had two levers to prop up the economy in signs of weakness. One, very low rates, and they're reversing those. But the second was QE, and we're reversing that with quantitative tightening. And here we sit with high and problematic inflation, yet the Fed is really providing a little bit of stimulus in the form of that tapering to QT. So we'll see where that has to head. That would be my primary question. Why now?
You agree, Ann?
I do, and I think a little bit of this too is the Fed's job is not to monitor the markets or to prop up the equity markets, right? There has been this big question mark, though, has the tail been wagging the dog? So I think, Jeff, that's a great point. I think some explanation is going to be needed.
Jeff, what is the bottom line corner at the House view at Thornburg about when the first cut comes?
Well, I think that the Fed has already told us they are in rate cutting mode, and maybe they'll reverse that. They probably should, but I don't think they're going to go quite that far. So I think the bias is still to cut, and I think they are going to have to be data dependent. I do think that we are seeing slowing in the underlying economy, and that will feed through a re-slowing of inflation. But the Fed has created a very sticky inflation on the back of the focus on unemployment and bringing up the low-wage income earners.
When you say cut, Jeff, is it September, December? Does it matter when the first cut comes?
I don't know that it really matters, but if I have to put myself down, I think it comes after the election cycle, and I would agree, it's apolitical in nature. It's just we need to see time for the economy to slow, so I'll put myself down for December.
And I want to get back to your point about the introspection that's needed. Nobody's expecting that to happen before a rate cut, right? So you sort of let the cycle pass. But at the same time, you're talking about inflation potentially reaccelerating, the concerns about Fed missing transitory inflation, whether that was in fact a miss as well. Doesn't that point to a larger issue within the Fed? And what kind of questions does that raise as we try to look to when that first cut comes?
You mean in terms of conviction and the ability to read that data?
And credibility.
Well, yeah, look, I think in terms of credibility, I think the Fed has done a pretty good job of restoring its credibility under very difficult circumstances. And I remember looking back in 2021, I felt like I was the Fed apologist because I thought there were such difficult circumstances to pass through what was really happening. If you went back a Kiko to December of 2023, I was in the camp of I thought we were just as likely to get a rate hike at the beginning of this year as we were to go the other direction. And I think there's an issue here around, let's look at the mandate of the Fed. 2% inflation target for maximum possible employment under those circumstances. I'm still slightly perplexed as to why there could be a rate cut. Because absent a really tough recession that gets us well below that 2% target or well below full employment, I don't understand what the rate cut catalyst is right now. Very simplistically.
So is that no move at all, or a potential hike going back to where you stood in December?
I think no move at all, because I think at this point the Fed has been signaling so strongly that a rate cut is on the come. But I'm in the camp of no move at all. I'd be more surprised to see a rate cut before the end of this year than I would to see nothing happening.
This issue, Jeff, of credibility is really interesting, just because it is true earlier this year, I think you could say most Fed officials were just sort of upbeat about that inflation trajectory. They got it wrong. I don't want to say they got it as wrong as transitory in 2021, but it was a miss. I'm just curious to get your take on the credibility of the central bank.
Yeah, I'll go back to that mandate, and I want to introduce kind of another concept, which is the Fed actually has a third mandate given to them by Congress. right? It's price stability, it's maximum employment, but it's also moderate long-term interest rates. And one of the things I've talked about is that third mandate gives them flexibility, which is different in a world where the Fed is trying to pull down inflation versus one that we're emerging from, where they're trying to push up inflation. I think that third mandate is social stability today, and it's compressing the wage gap. And so again, it creates a sticky form of inflation, but it creates the exact challenge that we have today. And it's a tough one for the Fed to deal with. So I think they've done an okay job, but a lot more conversation, a lot more questions coming up in the presser to see where they stand today.
Jeff, you said you expect if the cut's going to come, it'll be after the election. Is that just a conscious decision as you see it? You think the economic data will necessitate that? Why the timing as you see it?
It's because the bite of higher rates is working today. The consumer is slowing and it just needs more time. So it has nothing to do with politics. But I agree with something you said earlier. I think what the Fed needs to see is inflation to be durably below 2%, which is a real slowdown from where we are today. And I think that just takes some time, but it is coming.
What do you think, Ann, gets us to the Fed's target? What needs to happen?
I think we need to see sustained low levels of commodity prices. I think that's really important. We're seeing a slowdown in China. We're seeing that from earnings from Starbucks, from Apple. So I think that is going to be a piece that's helpful. And I think we do need to see the level of wage inflation to continue to do what it's doing, which is coming down. And we had the JOLTS report out today. The number of job openings, lowest in 3 years, but still incredibly high relative to broader history. And to go back to your point, Jeff, this idea of rates, being moderate. If you go back in history, even where rates are today, they are pretty low by historical standards, and we forget that, right? We really need to look at this through the lens of the broader history to understand actually that we're in a fairly moderate environment right now, as crazy as that sounds.
Yeah, it's that too many years of near zero.
Right, I agree.
Sort of got used to that, right?
Yeah, I agree.
And so I guess the question that Josh asked Jeff there, what is the one question that you have for the Fed chair today?
I think it would be, what level do you want to see the labor market hit? That's the metric. Forget what's going on in inflation. What do you need to see happening in the labor market to make a move?
Would that be the same question for you, Jeff?
I would ask Powell directly, and I would love to hear his answer, how the Fed thinks about that third mandate. Because again, it is given to them by Congress, but they never talk about it.
Yep. Jeff, Ann, thank you so much. That was great. Appreciate it.